Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. Fear and uncertainty in the financial markets, driven by inflation fighting central banks, slow economic growth, and geopolitical tensions, has driven risk off investor behavior. While this can be disorienting, the U.S. value team at Artisan Partners, led by portfolio manager Daniel Kane, views the market drawdown as a healthy readjustment to the cost of capital. This comes after years of central bank interventions that distorted asset prices and provided a tailwind for growth stocks. It drove less selective managers to pay higher prices and higher multiples. He will explain why today's shifting financial landscape will create more attractive investment opportunities, particularly for disciplined value investors. Dan Kane is a managing director of Artisan Partners and a portfolio manager on the U.S. Value team. In that role, he is a portfolio manager for the Artisan Value Equity, U.S. Midcap Value, and Value Income strategies. Dan, tell me a little bit more about your role at Artisan and your career path that led to becoming a portfolio manager for the Value team.
Absolutely. And thanks, Bob, for having me on the show. It's a pleasure to join you. I'm one of three portfolio managers for the U.S. Value team. However, my primary job is to function as an analyst. I'm doing fundamental research on companies. I've spent my whole career doing this type of research, getting into the trenches and gaining an understanding of the competitive advantages and profit drivers of a business. I actually find it interesting that the most common model in this industry is one where there's usually a senior PM and a group of analysts that report to him or her. The PM spends much of their time vetting the ideas that the analyst pool is pitching, and they get away from that which made them successful in the first place. It's sort of like a talented surgeon that stops operating and tells the other doctors which are the good cases to take. I came to Artisan in 2008, just before the peak of the financial crisis, which was quite a time to be switching firms. I'd been introduced to the team a few years earlier and had always respected and admired the way that they operated with a flat hierarchy. They had low egos, which, as you know, is a pretty rare thing in this industry, this business. Uh, the veracity of their focus and discipline, as well as the common sense approach to investing. And that way of operating just made sense to me. Prior to coming here 14 years ago, I worked for BB&T Asset Management, which is now Truist Financial. And before that, I worked for the state of Wisconsin Investment Board right out of college.
Well, let's turn to your philosophy and your process. And I understand that it's consistent across all three of your strategies. Give us a little insight into what you typically look for in an investment.
We're classic value investors. We sell what the market is buying and we buy what the market is selling. Most investors in this industry want to own stocks coincident with success. So we take advantage of those behavioral tendencies and we involve ourselves in situations where there's fear and uncertainty. It's a disciplined framework which we've been successfully operating in for over 25 years now. Margin of safety is central to our investment approach. Our three margins of safety are as follows: attractive valuation, sound financial condition, and attractive business economics. We view investing as an exercise in probability, and so our effort is geared towards stacking the odds in our favor. We want the business on our side, the balance sheet on our side, and valuation on our side. What's inherent in each of these elements is a high level of risk awareness. We think that's an important overlay in any type of investing. You can't be risk averse. You have to be willing to take risk as an investor, but you can choose to avoid extreme risk. And you can make sure to choose that you're focused on getting properly compensated for the risks that you do involve yourself with. And this framework allows us to do just that. For example, when we think about attractive valuation, what is most critical is that we involve ourselves in situations where there's low expectations. We want to own companies that are excelling at a distinct discount to the underlying worth. And our view is this really only happens when there's fear and uncertainty priced into the share. So rather than run from it, it's going to attract our attention. We're going to be finding the weakness in stocks like this to find the opportunities. For the financial condition elements, we focus on the balance sheet is the center of the plate issue. In short, we don't want the CEO or CFO worrying about the balance sheet and having it detract from their ability to move the company in a particular strategic direction. And then for the attractive business economics characteristic, here we focus on buying companies with solid free cash flow and attractive return on invested capital. We believe those are the necessary ingredients for the success of a business longer term. Importantly, all three of these elements need to be present for a company to find its way into the portfolio. And thus, we're creating a group of businesses that are better, safer, and cheaper. And buying companies with these characteristics isn't successful in every market or every environment, but it gives you a heck of a head start versus the index, which doesn't factor in anything like these elements that we focus on.
I've read your quarterly investment letters over the past several years, and one of the subjects that you talk about regularly is the challenges that value investors have faced during this period of easy monetary policy. And it fueled some of the more speculative areas of the markets. It led to asset price inflation really across the board. As a value investor, what can you share about the evolution of markets and what has that meant for your process?
It's a great question, Bob. Various policy interventions and bailouts over the past couple of decades have caused a whole bunch of market distortions, not just the ones we see today. For example, there hasn't been a true cost of capital in the markets for many, many years now. And as such, there's been very little penalty for companies that do wrong or risky things. For example, over leveraging the balance sheet hasn't cost much in terms of punitive covenants or higher interest payments. Bankruptcy's fallen for several years in a row. Corporations have made expensive acquisitions given the cheap cost of debt. And investors, frankly, have encouraged stock buybacks at a greater and greater pace with the assistance of leverage. So when your cost of capital is so low, it's easy to see why this has happened. I can simplify the reduction in the cost of capital as to how one determines the present value of an annuity. So, for example, when the discount rate of an annuity is ever lower and lower, the present value of the annuity goes higher. It's just math at that point. But it doesn't mean there's any less risk or greater certainty in the stream of those cash flows. It's just that the discount rate tells you the annuity is worth more. And we think there's more to thinking about that from a second level order. Given this backdrop, the low rate environment has supercharged the success of growth and momentum strategies. In this environment of free money, companies have been rewarded for pursuing revenue over profit, and many unproven and questionable business models have been allowed to operate and survive. Hyman Minsky's theory of disrupted companies has really been put on hold. Investors in those more speculative companies have enjoyed strong returns despite owning less proven streams of cash flows, and much of what they expect to happen is way out and in the future. So there's a long duration in terms of the stocks they've been buying. On the other hand, value strategies are typically associated with companies that have higher current cash flows and higher dividend payouts, and those have lagged to a significant degree. For disciplined investors like us with a rigorous process, this has been a very large style headwind. You can see this comparing the performance of the Russell 1000 growth and the value indices. The growth index has trounced value by over 120% over the past decade. However, this is reversed since late 2020, post the beginning of the pandemic, and values finally started to outperform, markedly so here on a year to date basis. And so it's been a very lonely decade to be a value investor, I assure you. To our credit, we've held firm to our process, not willing to reduce our hurdle rates or pay higher and higher multiples for companies that are showing some semblance of growth, or alternatively, we haven't been willing to pay high multiples to hide out in expensive safe havens. To our detriment, this has cost us relative performance points versus some of our peers, and it sometimes versus the index. However, we're focused on generating a positive absolute return for our investors, and we think the cost of capital should always be reflected in the riskiness of those cash flows that a business produces. And that approach is much more timeless, less affected by the whims of the market. So, fortunately, after over a decade, value strategies are finally beginning to get some traction again with investors.
Let's look at the macro environment. There's fear, uncertainty. It's being driven by higher inflation, the Fed and other central banks that are tightening their monetary policies. We've got a war in Ukraine, the slowdown in China, just to name a few. As a bottom up value investor, to what degree do you look at economic factors and forces in the way you make your portfolios or company selections?
Bob, today the world faces many challenges, perhaps more than we've seen over the last couple of decades. As you mentioned, inflation is running at the highest level in 40 years. Several European economies, as well as the US, are heading towards or already in recession. There are record levels of private and public debt, which have been spurred on by the artificial repressed interest rates, basically since 2009 when the central banks stepped in. And we've had 2 or more decades of deficit spending, at least here in the US and more elsewhere. Add to that, there's a tense and escalating ground war in Europe, which is the first since World War II. That's causing a variety of energy crises. We're on the cusp of winter here in the northern hemisphere. Currency fluctuations are becoming problematic for governments and corporations, evidenced by what we saw with the Bank of England intervention last week. And growth is slowing across the globe in a system that's really set up to thrive mainly under growthier scenarios. And then finally, the relationship between two of the world's superpowers in the US and China is growing ever and ever strained. All this on the heels of a global pandemic. So, how's that for a set of dire circumstances? It's certainly depressing enough to consider all those. Trying to effectively forecast how any one or even a set of these circumstances will play out is going to undoubtedly teach you a fantastic lesson in humility. So, we're not macro investors or we're not macro forecasters. I think we'd be horrible at it. It's almost impossible to forecast the macroeconomic environment with thousands, if not millions, of variables. So it makes the future from a macro perspective almost entirely unknowable. We use the circumstances that make other investors fearful to our advantage. We basically classify markets in one of two states: risk seeking or risk fearing. In a risk fearing market like we had in early 2020 and then again today, we use investors' tendency to sell stocks in a declining market to our advantage. It gives us an opportunity to buy high quality companies at significant discounts to their underlying worth. In that process, we'll make sure we're aware of the pitfalls associated with different macro conditions that could remain at those levels for an extended period of time, but we'll put our margin of safety advantages to work, combine it with a longer term time horizon, and then we're the ones that are providing liquidity to those investors who want to bail out in a sell off. It takes patience, a strong stomach at times, and most importantly, it requires a strong understanding of the fundamental value of a business. That's how we operate in an environment like this.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. Your team launched a new strategy earlier this year. That's the Artisan Value Income. It's an equity income strategy. It seeks to generate a total return from a combination of income and capital appreciation. And it also seeks to generate a yield that's more than or equal to twice the average for the S&P 500. The S&P 500 dividend yield right now is at about 1.7%. It employs a somewhat unique construction as you have the flexibility to invest across the capital structure, not just in common stocks, but preferreds and fixed income as well. Tell me about the strategy and why you chose to launch it now.
Artisan started back in the 1990s when everything was fairly style box oriented and style box structured. And as you might expect, as a firm, we've evolved through the years and been expanding what our CEO, Eric Colson, calls degrees of freedom. In our view, investment degrees of freedom is really about trying to create strategies that are not easily replicated. They complement indexes and add value over the long run. And value income is really the latest in this evolution towards those less restrictive solutions that are differentiated in the marketplace. Flows into equity income strategies have really accelerated here in 2022. Last count is about 42 billion in net inflows. And so we can see why there's demand for income strategies now. There's shifting demographics in the market environment with rising rates and inflation. Retirees, mainly the baby boomer generation, are growing as a share of the population, now estimated at 22% and rising, and they need income. Historically, investors could safely generate income via fixed income. However, with rates near historical lows, even though they're rising now and you have generational high inflation, core fixed income is facing headwinds as inflation erodes the purchasing power of those coupon payments. By contrast, dividend stocks are less impacted by rising rates and inflation because companies' sales are earned in inflation adjusted dollars. They can grow earnings and reinvest those cash flows back into the business, especially those with strong pricing power. Now, as we were looking into the evolution of this strategy and launching it, we discovered a problem with the equity income universe is that most approaches are conventional. The universe is stale. There's been very little innovation in the last decade or more, and we wanted to offer an unconventional solution to clients that's much more opportunistic. Broadly speaking, the universe is bifurcated between dividend growth strategies and bond proxy strategies. For the dividend growth strategies, they're investing in companies with a lower dividend yield that they expect will increase over time. But those managers are not delivering on yield and are instead focused on delivering capital appreciation, but they're paying very, very high multiples to achieve it. The other group of strategies are those that are focused on investing in bond proxies or ones heavily invested in blue chip companies. Think of things like your staples, utilities, and telecom. Those are providing attractive yields, but not delivering on capital appreciation and growth. So when we designed the income strategy, we studied the universe of managers and found that our offering is truly differentiated. We're bridging the gap between these distinct strategies and have even greater flexibility to do other things. And like you mentioned, the idea is to participate with broader equities and generate a current yield equal to or greater to than two times the S&P. With that cultural DNA of the firm as a foundation, the origin of the income product came in the early months of COVID in 2020. Companies we knew well were raising emergency financing at what we thought were very attractive levels, but were in types of securities we couldn't buy. The team was looking at each other, wishing we could participate in these opportunities. And frankly, we had a similar experience during the financial crisis back in 2008 and 2009. In addition, personally, we like investing in dividends. To paraphrase Howard Marks, if we can get a 3% yield on day one, we've got a good head start at achieving double digit absolute returns. As you mentioned, the product was designed with a lot of flexibility and that we can buy across the capital structure in areas like the common equity, dividend paying stocks, straight corporate debt, convertibles, preferred equity, or we can even create a synthetic yield through a combination of any or all these instruments. We even have the ability to buy stocks that currently don't pay a dividend, slash the dividend, or cut the payout, which is quite the opposite of the typical behavior of managers in this space. And then finally, the income product was born organically. It's just a natural extension of our existing philosophy, process, and capability. So it made very much sense for us to pursue a product like this in the marketplace.
So you've explained why you like dividend paying stocks over bonds, given the sensitivities to rising rates and inflation. Clearly, we've seen the impact of rising rates across asset classes this year. It's been an unprecedented year, not just for bonds, but really for the 60/40 portfolio. In your value income strategy, where you do have the ability to choose between equities and fixed income, how do you view the relative value opportunities between those two?
Currently, not only bonds are in a bear market, but equities are too. So we're in a somewhat rare period, at least in recent history, where both bonds and equities are down substantially from their prior highs. Because value income is an extension of our existing analytical framework we've used to manage our mid and large cap portfolios, we find ourselves in a pretty interesting spot. We're business analysts first and foremost. So we conduct due diligence on the business as a primary focus of our interest. And we find that the business is an attractive use of capital. We then determine which security has the better risk reward profile. So we're finding all sorts of opportunities across the capital structure in this recent drawdown. So it really depends on the individual situation, but having that flexibility to invest in other parts of the capital structure other than the equity really provides us an important tool to help clients achieve their income goals.
Let's look at specific sectors or even stocks. The broad equity market is in a bear market territory. That's 20% or greater drawdown from its peak. What opportunities should investors be looking for to position their portfolios?
Well, in times like this, we look for opportunities across all different sectors. Obviously, financials come to mind as a sector that stands to benefit from a rising rate environment. And thankfully, the balance sheets of banks are in a much better shape, generally speaking, as compared to the 2007, 2008 financial crisis. But we tend to go more on the offensive in market pullbacks like this, not shying away from companies that have a cyclical flavor or are more dependent upon the eventual recovery of consumer confidence or consumer spending. And that points towards areas like industrials, consumer discretionary, and some areas within communication services, such as media. It's similar to what we did during the downturn of COVID 2020. We found a lot of stocks in the consumer discretionary area that were priced for certain death, and we were able to take advantage of eventual normalizing of those results and add them to the portfolio. Technology is an area we haven't done a whole lot in for a few years, given the high valuations, especially in areas like SaaS software or the chip makers or chip equipment companies. But even those stocks have fallen dramatically here, given the retraction in risk appetites and higher rates. However, each of the names, as I mentioned, need to pass the rigorous due diligence process and fit within that margin of safety framework I mentioned earlier. I'll say this: we're certainly busier than we have been since the throes of the pandemic in early to mid 2020, and we're finding lots of things that are hitting our radar in terms of new stocks to potentially purchase.
Well, it's nice to think that media companies are among those that you think are attractive, given that we are a media company. If there's one key takeaway that you'd like to leave with our listeners, our audience of advisors, about your outlook for the asset markets, whether it's in terms of value versus growth or stocks versus bonds or any other dimension, where do you see the most opportunity?
Well, it's an interesting question because value investors often get colored with being dour, uh, depressed, having a bad outlook on life simply because of the different parts of the market we traffic in. But things look fairly bleak right now. But there'll be positive returns again in the market one day. And over the past 150 years, it's paid investors very well to go on the offensive when times are tough. It reminds me of a quote by Warren Buffett, and I'll paraphrase it. It was something to the degree that over the long run, stock market news is going to be good. It's going to be fine. In the 20th century, the U.S. has endured two world wars and other traumatic and expensive military conflicts. There's been a Great Depression, a dozen or so recessions and financial panics, oil shocks, a couple of flu pandemics, and presidents have resigned in disgrace at various points in history. So, uh, you know, markets eventually moved higher after every one of those setbacks. So we follow Buffett's advice. Ignore the daily noise, look for great companies selling at cheap prices, and if you're right about a business and you've studied it longer term, it's trading at an attractive price. It's going to be foolish not to take action based on something you thought the market would do in the short run. When there's palpable fear in the market, that's usually the best time to generate strong future returns by buying into that weakness and panic selling. So that's the mantra we generally live by.
Well, thank you. And we'll include some links in the notes that accompany this podcast. There'll be a link to the Artisan Partners website and a link for more information about the Artisan Value Income Strategy. Dan, is there anything else you'd like to add?
Just want to thank you for having me on the show today, Bob. You and Advisor Perspectives for having me, and I hope be able to join you again soon.
We would love to have that opportunity. Thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Dan Kane of Artisan Partners. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.